Hello and welcome everyone to the weekly Delphian meeting. Thank you for attending. So today we're going to go through our normal kind of market update, and Shawn's going to go through some earnings trades as we're kind of in the, really earnings trades are really starting to pick up. We talked to Ashok and tried to get him on this week, but something came up schedule wise, so he will be, so we're trying to get him for next week. So he blocked that off, and hopefully you'll be able to attend next week for the weekly meeting here. Sorry about that, but we'll get started anyway here. Okay, so from last week, all of these were pretty much the same. Russell still in 2 and everything else holding in 1. We did have an increase in the overall bullish states. We got up in the 70s here, so we're back down to 65 in all the bearish, but still overall pretty bearish. The state ones, I think we're around 20 something last week, so we're back up to 30. Nothing too significant though. So let's look at market pulse here. So, still holding above the state 8s. They have been increasing very slightly. So, we're down at 8. Now we're at 18. So they're still kind of climbing. So, we just have to watch that. We know that the bullish bearish, and we'll take a peek at that. All the bullish states and bearish states are, that one crossed over a while ago. So, so something to monitor here is overall on the state ones. The new lows, we had that good spike. We talked about that last week, and I said, if these things can maintain a high level, something to be concerned about. We did have a little drop, but they're kind of creeping back up. So if these stay elevated, then that's definitely a cause for concern overall. But this kind of, I think, secondary to I think our most important ones, the SPX 50-day. That's been our moneymaker this whole time. So I think this is just kind of be careful. Watching these each day. We got up to 400, but so pop back up yesterday. I'm not sure today's kind of I guess a mixed bag. So just keep an eye on that. Any kind of sustained movement on the lows will be that's the market moving big time. So we're still elevated, and just keep an eye on it. Definitely a kind of a small warning there on so that's the market pulse. So we can take a peek at this bullish bearish. I don't do it that often, but it's always provides some good intel. So we had that crossover back in June. So markets got pretty bumpy, still grinding higher. Obviously, with the loss of breadth in the market, we're still driving higher on SPY and things like that. What I did notice is we got up pretty high on the bearish there. Sorry, I still got people joining. That's a pretty high mark there, 71.6. So it's looking back, that's, you get up around 70. That's so these are all like right around 70. Obviously, you get pandemic, you get crazy stuff, but a lot of these. Let me take off the bullish here. Really confuses. So a lot of these get up around 70, kind of turn around. So that's kind of what happened there. Obviously, can pop above, and so, but that got up. I would say kind of a oversold ish level, and I'm not calling it that yet, but I was doing some of the analysis because Lee brought it up. Like you don't have you have an overbought, but you don't have an oversold. Um, so that one looks decent. I went all the way back. So 70 kind of gives you a little warning on that. So that's why I wanted to bring it up. God bless you. Okay, so that's market pulse. So we'll go through the individuals. SPX still, nothing changed here. Still running well above T3. This one keeps making new highs. Obviously been doing very well. The 50-day has been our money maker. So I'd say this is obviously the key thing to watch here. It touched, back on June 19th. I haven't even counted the total number of times it's been touched or breached and came right back, but it's quite a few for this pandemic. And, I think this is kind of the key right now where we should track overall for the indices. This isn't giving us info. What we can look at is NDX also. So this one, this one's kind of been battling at target 3. Obviously, breach down, pop back up, down, back up. So we'll see if this gets tested again and turns into good support. It's kind of been a fight here back and forth. So if this can turn into support, then obviously very bullish sign overall for NDX, which is looks like it's trying to take leadership back overall for the market. So that would be another kind of key level on the downside there. And then the Russell, we talked last week. We talked last week about Russell being range bound, and I figured it'd be kind of range bound in the state too also. So this one is kind of held up, for that top level and then down at this bottom level, see which way it kind of breaks out. And, obviously it's just been in a consolidation phase for a very long time. So this would be another kind of key level, see if this can, that was a terrible line, sorry. See if this can, that's obviously not a straight line, but I tried. So it's probably more like here. See if it can break below there, or if it makes another run up to test the top end of that range. It's going to break out at some point, one way or the other. So I think that'll be a good indication of market direction. But 2 here, obviously, popped up, ran down to target 3, passed, ran up, and then now we had this is providing resistance here. The entry price, you can see, tested here. Immediately came back down, tested here, came back down. So, I think that'd be your key top end level to watch right now, because the other ones are, we don't have much on the high side or the upside as far as targets and things to watch. So, a lot of downside targets to watch though. Okay. Sorry if my internet's been a little sketchy lately, in case my voice breaks up here. So that was the quick down dirty on the market. Bring it up for questions or comments.
Quick comment on earnings. This is a pretty big week for the mega caps, and so far it's been kind of stable. So with the Fed not doing probably much until Jackson Hole, and I don't see why the S&P is not going to make too many changes, and the Russell's going to stay where it is until there's an infrastructure bill passed, I think. So whole lot of changes from where we've been to where we're going in the very near term, to like next week anyway. So good luck, everybody.
Yeah, well, the Fed has comments, I believe, is that today or tomorrow? So, the Powell's going to be talking, and then, Jackson Hole is obviously the big one. And I did, Sadir did send something, I think it's from, what was the guy's name? Dan Niles. So basically he doesn't come out much as far as, can you guys hear me all right?
I can hear you
I
fine.
Okay. I'm just people chatting saying my audio is breaking up. So this guy basically thinks, and we've been talking about inflation being, a really big issue out there and could be a driver for, market turnaround. So that's kind of what this guy is saying, if you look at the red here, we believe the Fed signal started tapering at the Jackson Hole. I don't know the exact date of that. It's in August, but I don't know the exact date for that.
August 26th through the 28th.
Okay, there's Sadir. He's on it. So I thought this was an interesting piece because we've been talking about this. Watch out for inflation. Obviously, I think a lot of people have been experiencing inflation, grocery store, things like that. I mean, the housing is really red hot on prices and stuff like that too. So a lot of things are inflating. Year over year ratings look pretty high compared to what we've seen in the past. So, and what they had kind of surmised here is 10 to 20% correction before year end. So that's kind of what he's saying. We spoke to Shook this morning briefly. He had similar sentiments that something, and he thinks it's going to be kind of closer to the end of earnings that, we're going to get some kind of pullback. So that's two sources for you. It's hard for me to say, my personal opinion, I'm kind of just watching that 50-day SMA and, until that's breached on the SPX. It's kind of, you keep betting on it until it doesn't work. So, so it's been working really well for a long time. So at some point it will be breached. I don't know exactly when. Usually, I mean, what I've seen in the past is, after these earnings, that's kind of usually the time. And I talked about that right at the end of last earnings, like, hopefully we could get a correction between the earnings. That's kind of, it happens a lot like that. It didn't happen last time. So, possibly next time, the end of this earnings, that's kind of the ideal time for, not a lot of news coming out, market gets complacent, people, maybe some bad news or something. So, we'll see what happens. I'm not making a specific call myself, but you have two people here basically saying that. So thanks for sending that, Sadir. It was very long and I didn't want to, spam everyone. So I just kind of gave you the highlights. If you want this article individually, just reply to the, weekly email and I'll send it to you.
Yeah, I just wanted to also say that the market took the CDC upping the mask situation just yesterday evening pretty well in stride today, but that might have been countered by the few blowout earnings on some of the mega caps that just came out today. So maybe one countered the other a little bit, but seem to be taking the variant in stride at least for a while here.
Yeah, that's kind of a. It's hard for me to say one way or the other what this COVID stuff is going to go out. It seems like there's, quite a few states that are resistant to any mask, Florida being one of them. We'll have to see how this all plays out. We're getting into, as we get into fall, that's a typical flu season. So
Hey, Josh.
Yep.
Lee here. I keep hearing that the market, and you show it, I think, when you look at the market pulse, that it lacks depth or breadth, however you want to say that.
Yeah.
And that it's the big mega stocks, the Apple, Microsoft, Google, that are holding up the S&P 500. And I wonder what you think about that, because the trades that I've been making over, let's say, the last month, they've been getting more and more difficult to end profitably.
Mm-hmm.
And because those are not the big mega stocks,
Right.
does that tie in any way to your thoughts about the depth of the market?
Yeah, I mean, we have all these. I mean, if you look at the percentages here, a majority are in bearish states. So that means, 4,000 stocks or whatever. We got, 2,500 in bearish states. So I don't know how that breaks out on the liquid list, that we have, 300 something, but yeah, it doesn't seem like they're like tanking. It's just kind of like they're lollygagging, kind of. Just look at the Russell. It's kind of range bound. So I think a lot of those are also range bound. You get a little pop and then it pulls back right back to where it was, type thing. I'm sure there's some that are like tanking, but that's why we talked quite a while ago just about what seemed to be working, and it wasn't calls. It was the bull calls were doing fantastic. They're still doing really well. For all those studies and things. So I think, when we talked about that, hopefully a lot of people, steered away from, long calls outside of earnings type stuff. And, they're putting on spreads, either bull put or, the bull call ones, because those have been working really well. Whereas long calls are kind of hit and miss,
Yeah.
So,
all right. Thank you.
Sure.
I have noticed that the trades work better when the green pie is expanding.
Mm-hmm.
And, I mentioned that it was shrinking, the green pie in the market pulse chart.
Yeah, this one.
For 6 weeks since June. And then just as of last Wednesday, after our call,
Mm-hmm.
it started to expand.
Right.
And I've had just in the last week, a number of trades hit. I had 2 earnings trades hit their profit target this morning, right?
Right.
And, that green pie is a real good, easy, it's just a shortcut for the breadth of the market. When it's expanding, the market has some breadth to it, and bullish trades seem to work at a higher percentage. Now, this is just anecdotal, but that's just the feeling I get, is that that when that pie is expanding, the trades work better than when that pie is shrinking. The month that it was shrinking, I also, like Lee said, had fewer trades work.
Right. Yeah. Well, that's a very good observation. Just like a kind of market breadth indicator.
Yeah.
I haven't thought of that, but that makes a whole lot of sense to me. We can definitely do some analysis on that. The trend analysis on those. But yeah, I got up, like I showed before, I got up in the 70s, and that's kind of, historically, what I spent like 20 minutes kind of looking back. That's pretty high level, and they usually turned around at that level. Not always, but majority of the time. So
If it got to that level without the major indexes dropping that much,
Right.
which of course is just an indication of the lack of breadth in the market. It was the big guys carrying it, right?
Right. Yeah, it's definitely a weird market, like this whole pandemic. I mean, we were up in the 70s on state ones, and everything, just a slow creep all the way down to 20s, in state ones, and just a big loss of breath, and then little pops it's very interesting, weird kind of market, I would say overall.
It sort of feels like that individual investors don't really have a firm view or fix on where they think parts of the market can go. So they're putting their money into what they think is going to be affected the least by whatever changes happen to come out. And that happens to be those mega cap tech stocks that don't have a lot of foot traffic that need to go through their stores and stuff like that. So it's kind of like not a fear of missing out, but a fear of, well, not knowing where else to put any money. So that's where they've been putting it.
Yeah. Yeah, that makes sense. So,
Hey, Josh,
Yep.
me again.
yeah, like,
I don't want to add to your burden. I know you guys are really busy. But when we talk about how these trades are trending,
mhm.
and they seem to be getting fewer profitable, is there any way to programmatically, not you do it by hand, since you're already tracking all of these trades,
Mhm.
to go through and look at them and say, okay, for the last 90 days, this is the winning percentage. For the last 60 days, for the last 30 days, for the last 2 weeks, the last week, so that you could begin to see a trend in there. Do
Right.
you know what I'm trying to get at?
Yeah. Oh, yeah. I know it exactly. What. Yeah. No, that makes sense. I don't have a way to do that easily. It'd be very labor intensive, but
Yeah.
I think that's a good point to bring up, and I think we can get people. Yeah, it's all with the virtual portfolio. So, like I have all those, have all these different ones that I'm tracking every single day.
I know you got a ton.
So, I have all these, but, when I pull them up, like this Keltner channel pullback bull call, like this one's been really good. So I don't have any way to pull up, right now. So it's like 36%, based off 100, and, I probably only use 50,000 max at a time. Max, and probably not even that. So it's, the return on capital is like underestimating. It's just based off of this 100. But yeah, like being able to pull out, metrics like that. It's all individual tasks like right now. So
Well, that's too much. So don't do that.
yeah, no, but I think it's a good thing to be able to have. And just, it's all manual right now. Like all these closed positions, it's not even loaded yet. There's a lot.
Okay.
So,
Okay.
like all this is all like manually done. So, and these are just the high probability. So everything that pops in that, from that email every day. So,
Okay.
yeah, that's a good point. And, I'll see what we can do to try and get better metrics out of this. Yeah, I think it's a good thing to have and be able to, provide updates on that on a regular basis. That's not super manual intensive. So I think it's a good project for us to have. So,
All right. Thank you.
yeah, good idea. All right. Anyone else got questions, comments for Shawn goes here? All right, Shawn, you ready?
I'm ready. How's everybody doing?
We're doing good, Shawn. Thank you.
Appreciate it. Give me 1 second. Share here so it says here doesn't have to remind me. So yeah, what I wanted to do is just show, like Josh had mentioned, we have earnings season kind of ramping up, and then Dave mentioned as well some big companies reporting this week, from Tesla to Apple to, Amazon, I think tomorrow. And then there's been some vol crush non-mover trades. There have been some bullish pre-runner trades. Briefly spoke to Sid here about some of the trades that he's been doing. But has anybody else been doing any of the earnings trades, either, long calls, bull calls, or the butterfly trades or anything like that? Anybody want to give some insights on what they've been doing? No problem if you don't. I know the Tesla had a vol crush trade. Do you mind specifying, Satir, which of those trades you got out today? Because I know some of the trades that I'm looking at, if I didn't trade them or I have them in the virtual portfolio, I won't see the exit until tonight, as long as the stock stays up at that price level. But are there any ones that you want to speak about?
Let's see, it was, hold on.
Don't mean to put you on the spot, sorry.
C.H. Robinson and Microsoft.
Okay, yep. So the Microsoft, was that?
Go ahead.
No, Microsoft, was that for the vol crush or the non-mover, I think? Okay.
Right. That hit the 15% target. C.H. Robinson was a strangle. I'd have to look back. I don't know if that was a mover or vol rise.
Okay, right.
It hit its target. Now there's a vol crush that is profitable. What was it? I was looking at it earlier. But it hasn't hit its target. I may just close it out today because it is profitable. Let me look.
That I know Norfolk Southern had dropped a bit, and that was on there as a vol crush.
Norfolk Southern, at least last time I looked at it this morning, it was sitting at a profit, but it hadn't hit 15%.
Right.
And, I'm sitting at 78% win rate and 1.64 profit factor.
Okay.
And as I mentioned when Josh was talking, I think they've started working a little bit better now that the green pie is expanding.
Right. Okay, good. Yeah, I know that a couple of them I know Microsoft had come out, and then NSC had dropped down a little more. Microsoft kind of stayed flat. And, there were some other companies that had reported last night as well. Apple was one of them. And there was another one that I was tracking as well. Now, Apple wasn't on any of the lists. And, as we had shown before, when we did the, vol crush list or the non-mover list, we tried to minimize the actual trade that we were getting. And one of the ways to do that was to be somewhat selective on, the profit factor and the win percentage. So, I'm not sure if it was the vol crush trade, but yeah. So we'd seen Apple was on the vol crush trade on the raw data when we have over, 113 trades. But we can see Apple would still be a great trade, right? I mean, it was an 80% win rate over the past 10 quarters, 2.5 profit factor. And I think it pretty much stayed, relatively flat today on earnings. Earnings wasn't a big mover for Apple. Let me see what it was down. It's actually down $2.50 now. So I think when it opened, it was a little bit lighter on the open, which would have helped that vol crush trade a bit. And then one that we have coming up in a couple of days, Amazon, I think it comes out tomorrow evening, but a really big trade in the fact that Amazon's, $3,600 a share. So obviously the risk on that trade is pretty substantial. I think around the $5,000 to $7,000 or so. So a big risk trade. But that one didn't make the list either because of the profit factor not being above $7, but it was an 80% win rate on that vol crush when you test it, within the platform. So even though they're not coming out, as a vol crush trade, there still might be some on this raw data list that you might want to look at, just depending. So, take that and kind of examine it if you want to do so. I did want to show everyone.
Real quick, Shawn.
Of course.
Are you closing the Norfolk Southern or are you letting it ride?
Well, the Norfolk Southern, I have it in there in the virtual portfolio to close at the 15%. Now, let me just look. Is that a non-mover or was that a vol crush? That was a vol crush, right?
It was, yes, a vol crush. And I'm just curious if, I don't know if you're closing it today per the guidelines or letting it ride.
Yes. Yeah, I was just wanting to verify that it was a vol crush. So yeah, as per the guidelines on the vol crush, I would close it today. And like you say, you know, it's right. I mean, it's profitable, but it's just holding on, and the stock seems like it wants to sell off. But that, you know, not taking that into account, really, right? I would close it today based on it being a vol crush.
Yeah.
And then Microsoft, since it was the non-mover, if we had to hold it till next week, we could hold it. But like you said, the profit had already, you know, popped out of there this morning, so it's great.
Yeah.
And I think it's flat right now, right? It's like, I think it's down 3 cents or so. So it's pretty much right on spot. It probably coming into the close. So
Right.
that should reflect pretty good in the virtual portfolio as well. So yeah, close that one based on the vol crush.
Okay.
But yeah, and I did want to mention something I mentioned to you yesterday, Sudhir, is there's some trades that we've been tracking. We've talked about them before. Dave's ears are going to light up, I think, a little bit. But, you know, we were talking about the, you know, the vol crush trades or the non-mover trades being the iron butterfly or the iron condor trade setup strategy. And we talked a little bit about those double calendar trades. So, you know, what I would like for Dave or for anyone else to do on the call that wants to take some time to do it is I've been analyzing those trades for a bit, and I haven't really found a great consensus one way or the other, and I haven't found a reason not to actually trade those trades live. But I always feel like I've mentioned before that I feel like once I do that, then, you know, the worst case scenario happens, and then I get slammed for some reason when I wasn't expecting to do so on the loss side. So what I want to show you is I did put the trade in there. So I matched it up with two trades with the Tesla trade. So Tesla had a trade, you know, they had the earnings yesterday morning or the day before yesterday, I believe, in the evening. So I tracked both trades, and I want to kind of show you the setup and get your thoughts on it. So I used the virtual portfolio just kind of like I preached to everybody. I really am using it for this double calendar to try to get an idea of the good, the bad, and the ugly with this particular trade type. So if I pull up my vol crush trade, so I did go back a day to 726. So if I pull up my vol crush portfolio, this was the day that I actually did enter in the Tesla trade. So I entered in the Tesla trade. Earnings was the night of 726, I believe. I just want to make sure I'm not telling you something wrong. So on after market close 726, the Tesla trade, they had earnings come out. So this was the trade set up. When I put the trade in, I actually put it in for the following week's expiration, like we've talked about. I actually did, the market was right around 657, 658. So I used the 660s, and then I did it balanced. So Sudhir and I had spoke before about some of the trades coming over as not being balanced when they've been back tested. I would always do the trades as balanced. So, you know, if the stock itself is at, let's say, 660, and then my expected move is around the $60 range, then I would do, you know, a 600 and a 620 or a 720 on the opposite side. So a 720 call and a 600 put. This 715, 600 was what was recommended within IR, within the back test. So I wanted to track that one as is. So that's the trade setup as the vol crush would be. So does anybody have any questions on that setup? Nope. Perfect. All right, cool. So we can see that, you know, my risk is skewed to one side, and then we can see the risk is sitting here, and then we can see the actual max profit for the trade. It was pretty quick. Tesla had come out with earnings, and that there was like a leak, I believe somebody had said that there was going to be really positive earnings, and they were really positive. They had great earnings from what the market had expected. I think it was, they reported 1.45 per share, and it was expected like 0.52. So almost triple what was expected. But the stock still pretty much went sideways, had a pretty tight range. So if I move forward one day to 727, we can see the Tesla trade, you know, actually was working for a gain or a loss of about, you know, $555, 14 points. Return on risk was 14.77 at the close. And that, you know, this is end of day data. So intraday, it definitely broke above that 15%. And you could have got out for that 15% profit in the day for that Tesla trade. It was a little expensive. You know, I think your risk was, like I said, your risk was about, you know, $2,000, somewhere around that range. So a little bit on the risky side, and I understand if we don't want to do that, but just to show you, I still track them no matter what. But what I do want to show is that double calendar. If I go into my portfolios and I set up this double calendar today, just to kind of show you, we can see that, let me go back one day. If I entered in the Tesla trade the same time, I just want to kind of bring your attention to the risk with the possible reward on the trade. So we can see that when we're talking about a double calendar, what we're looking to do is we're looking to, and Dave has a little bit of a different opinion, but this is the trade design that I kind of heard about and been looking at. So what we're looking to do is for volatility crush, we're looking to take advantage of the volatility premium that's in the options for this week's expiration, because Tesla has earnings coming out this week. So we're selling the 730, 660 call, and 660 put. And since we're selling those options, that's where we're looking to receive a lot of that volatility crush, because we're selling them. And once the volatility crush happens, we look to buy them back at a cheaper price or a less expensive price. Now, if we did that just by itself, so I'm sorry, I was pointing to them differently. If we just sold the 660 call and the 660 put for this week's expiration, we would have an unlimited amount of risk on the table, right? The stock can only go down to 0, which we're limited on that side for the risk. But on the upside, we're unlimited risk to the upside to infinity, essentially, because the market, Tesla could go to a price of infinity. Typically not going to do. I don't think I've ever seen it happen, but that obviously is cover your butt scenario and make sure that everybody knows it is unlimited. So to protect ourselves from that unlimited exposure, what we're going to do is we're going to buy the 660 call that expires next week, and we're going to buy the 660 put that expires next week. So now we're short options for this week, but we have the same exact strikes for options next week that we're using for protection, and we're buying those. So when we do that trade, so when I sell the 660 call and 660 put for this week, buy the 660 call, 660 put for next week, we have a debit on the trade. So it is a debit trade. And when we look at these two trades together, the debit's roughly $900. So this is where I am still doing some testing, because I know my max risk, according to the fact that it's a debit trade, should only be $900, but I'm wanting to make sure of that. In a worst case scenario, is that the most I can lose? It's a debit, so it should be, but I haven't had enough experience trading it to verify that scenario. So, since it is a debit, $900, that's fair. Now we're looking really obviously for the value to go up, because we're buying it in the beginning as a debit and we're wanting to sell it at the end as a credit. So we're looking for the value of this to go up. When you look at the value of the implied volatilities for the various options, the options for this week expirations should be, inflated more than next week's, and that's where you should get that volatility crush and that premium. So what I wanted to make a note of is this trade's roughly 900. The risk on the original Tesla Iron Butterfly or Iron Condor trade for the vol crush, the risk is roughly 1,800, so almost double. So double when you're doing it, when you're doing that vol crush with the risk, but obviously, the credit's going to be in play too for that other trade. If I go ahead one day today for when you should get out of that trade, we can see that the trade increased. So about $182 on the put side and $170 on the call side. So roughly, $400. And I tracked it on another system as well, and that was about the same. It was $900 to get into the trade prior to the close before Tesla had earnings, and it was worth about $1,300 on the open. So you would have made about $400. So roughly 45% or so on the trade pretty quickly. So I just wanted to show you this trade setup. I'm hoping to get our IT team to put this in as one trade. I did have to enter it in as two separate trades, a long call calendar spread and a long put calendar spread. But typically you're going to see these as one individual trade, and those are going to be your four legs, and then everything would just be added together to see that. Any questions on that trade setup or kind of how that works?
Interesting.
I can comment on your question about your not making sure about something. I would say you're on point as far as your risk assumptions, max risk assumptions are, as long as you close it on the week on the expiration of the first week, and don't hold it over the weekend after the first expiration. Because if you do, then you run a big risk of reversals, and if you're going to have to buy one of these back, no matter what. If it moves away from it, the at the money price, which is your short strike that you bought this at. You bought this as a neutral play, hoping that it doesn't go anywhere. Right.
Right.
If it does go somewhere, you're going to have something to do with one side or another. Now, what you didn't mention was there's some flexibility in this trade that once you know and the earnings is out, you can, one side will be obvious and the other side will be, well, maybe I want to turn this into a spread trade, a vertical or whatever, or you know, you want to be a short, you know, taking a credit for it being a vertical on that side, or you can play for a debit vertical and the price keep going on that. So it's got some flexibility built into it. But there's a risk if you hold over that first weekend, then your max risk assumption is probably not valid for that.
Right.
I tend to use this as out of the money strikes and do that, hoping to close one of the sides on kind of like the optimum area, more in the optimum area, just like the iron butterfly, and then do something with the other side. But I usually don't close on the first week unless it's right. Well, I close one side if it happens to hit my strike, because that's what you do. And then the other side is,
Right.
you know, you turn it into a vertical, or you just hold on to a lottery ticket and, you know, hope that there's a big reversal, and then you'll be a winner on that too.
Right. Yeah. And
in this trade, there is.
You're right. Yeah, there's definitely a lot of maneuverability I think that you can do. And the reason that I had thought about this trade was we were listening, and I think I spoke about this before, we were listening to someone talk about it, using it in a different setup. And obviously they want you to buy their program and pay money to get the information of which stocks are going to perform best. And, you know, I'm assuming it's based on the implied volatility being increased coming into earnings more so than normal. But the trade design that they had talked about was, you know, getting out the very next day. So, you know, you're looking for the volatility crush happens or it doesn't, stock moves up or stock moves down, and then you just get out of the whole trade, take your lumps if you lose money, or take your profits if you're making money. And then like Dave said, you know, if that happens, you know, if a Google happens like it did last night and the stock's up, you know, 4% or 6%, you know, maybe covering one side and being more aggressive on the other might be the play, or changing it into a different type of spread. I haven't got to that point yet because I'm just not, you know, as forward thinking as that yet. I'm still trying to figure this one out and just to make sure I can make money on that, you know. But like Dave said, I think it does offer some maneuverability. And to his point as well, I'm definitely going to make sure that I'm out of these two positions here because they are expiring in a couple days, you know. So I want to make sure I'm out. And then obviously if I'm holding those to expiration in a stock like Tesla or Google on Friday, I do have that big potential of being exercised. And now I've really just turned a decently complex trade into a way more complex trade than I want to have to deal with. So yeah. So does everybody kind of understand the trade, or some people still like, whatever, I would never do that? I just want to kind of get a consensus on anybody's thoughts. And don't feel bad if you don't want to do it, because I've only traded it, I think, once so far.
And just to clarify, you're putting this trade on just the day before earnings or the Monday of the week before earnings?
The session right before earnings, just like you would do with those vol crush or the non-movers. So I've been running the vol crush and the non-movers as we have in our earnings plan, and then I've been running this trade right side by side with it too, to see if I can get a difference between the two and you know, risk wise, profit wise, or so on. So Tesla had earnings come out at let's just say 4:30 on Monday. I put the trade on right before the close on Monday, and that was just based on Tesla. So Amazon, you know, Microsoft, like Sudhir said, Microsoft had earnings last night. I actually did the trade live on Microsoft yesterday. So I did the normal iron butterfly, and I also did this double calendar for Microsoft because the risk was fairly inexpensive.
Yeah, the reason I asked that question was because if it's a non-mover especially, and your short option will have more value if you have more theta days in there than just the last day. So if it doesn't move, you'll have a little bit, it'll be cheaper to get into because your short option will take more of the bite out of the long potential there.
Right. And that's the thought, right? The volatility or the value of those shorts will drop significantly more than they will on the further weeks. So then that's where you could get out and gain that value. I believe, that's what I'm thinking, right?
Yeah, now I'm with you.
All right. So yeah, so let me, is everybody fair on that trade? Because if they are, we got a couple minutes and I just want to show you the Microsoft trade. And Dave can jump into, or Joe or anybody who's here. I almost feel like some of these trades work better, the double calendars, maybe on stocks that have a less of an expected move. So if the value of the debit is, $5 and under, it seems like those work a little bit better, but I guess it's all just dependent on the move of the stock after earnings, right?
I would agree with you on that, especially whether it's a double calendar or a single calendar. If the implied volatility is lower for this particular cycle than usual, in other words, less than normal, of a outsized expectation, then I think the calendar, the time trades tend to working a little better. When it's like a crazy expected move and you're playing within the move, you have a better chance to be successful because things just haven't moved all that much in the preceding quarters anyway. Now,
right.
I've listened to TDA quite a bit, and the guys that do earnings plays almost every day there have commented that they've been getting burned. They admitted to getting burned a little bit more, not in such short language, but because the moves have been a little more outside the expected ranges this earnings cycle than previous ones, which would imply that if your iron butterflies might be harder to win out now than they were before too. So, like each earnings cycle's got its own little characteristics, and it's you have to go with the flow there. And I also wanted to make a comment just because nobody was chiming in there that they were doing trades. I actually have been doing quite a few. I think I did 4 earnings trades last night. And I used the Delphian, all the things that we've learned through Delphian here in my thinking on all those trades. But the reason I kept quiet is they haven't been precisely as prescribed by our methods here. For example, I did a half a fly instead of a whole fly on Starbucks last night because I had a definite bias, and I also did a calendar trade to the bottom side. And we'll see where those match up. But first day in, they're doing pretty good. But none of the calendars and butterflies start to inflate until you get closer to the short expiration. So it's more of an art to management and those trades. But the point is, yes, I do listen and use almost everything we've talked to, but I tend to bias sometimes what the particular stock is doing at the particular time. And a lot of the stocks in this earnings cycle, especially the mega caps, ran up quite a bit right into earnings. And so when they have a big implied move still and they're at the top end and they have a good earnings beat, well, not much happens to the stocks. So the vol crush trades tend to work out pretty good then. So I'm taking what we've learned and kind of like applying it on an individual case, and I think it's very helpful. So don't think it's not. Is kind of what I'm trying to say.
No, that's good. I mean, I appreciate it, no doubt.
Shawn?
So, yes.
Hi, it's Jean.
Hi, Jean.
Hi. Well, I did 4 earnings trades too. 2 of them I've already closed, and 2 are for next week. But and Microsoft, I think, is beyond the wings. But I love the iron butterflies, and I apologize to you, Dave, but I find the calendar so hard to do that I just haven't really worked on it very much, you know? They just seem complicated, but maybe that's because I spent so much time over the last several months learning the iron butterfly that maybe my brain can't take in anything else when it comes to earnings. I don't know, but
No.
that's why, you know, we've talked and I just still have a hard time with those trades. So for me, when it comes around to earnings, I'm really, really looking for that iron butterfly setup. And
Gotcha.
so far, 2 of them have closed already, and the other 2 will close next week or before next week. I'm just looking for 25%, Shawn,
Hmm.
on these because I don't want to take the chance, you know.
Right.
But
And I know you have experience doing them before too. So you're, you know, the 25% is a little more than some that we've tested, but I think that's a fair assessment as well. So
yeah,
Hey,
yeah,
Jean,
yeah.
go ahead.
this is Joe, and I congratulate you on your hard work, you know, in getting comfortable with the butterfly trade where you say you love it. You know, that sounds like you have confidence in that trade now, and that's just hard work. So good for you. I think one of the differences between the butterfly trade and then the calendar, the butterfly is black and white in terms of what you can lose and what you can gain, where the calendar spread is not. As Shawn said, you know your debit. The debit is what you can lose, but you don't know what you may gain because that change in the implied volatility is inexact. So if you go forward and start to work on that calendar, I would just, you know, offer that, you know, the upside, if you define your profit by, you know, the percentage you want to make, you know, I think that will work, but it's not one of those black and white ones where you know exactly how much you can make at a max point. That's all.
Well, you know, Joe, that's probably a good point because I like everything I have to understand all the math and the figures, because if I don't, then I start getting, you know, very negative about the thing. And you know, I've lost on some of these iron butterflies, but I've also won on a lot of them. So I just, they're easy now if you know, try to stay, you know, outside with the wings and everything. But again, they can go beyond the wings and then you're trapped and you have to get out as soon as you can unless they start to reverse. But yeah, I like everything kind of black and white, and that's why I like selling premium rather than buying anything because I just that's just
I
me.
think if you get a chance, you know, to study these calendars a little bit, they're actually an easier trade to understand because you're only talking 2 legs versus 4, and you're only picking
thought that
one
was
strike
gonna
as
be a four-legged.
opposed to 3.
Wasn't that going to be a 4-legged trade, that one you were reviewing, Shawn?
Well, essentially it's a double calendar, but that's when you're doing the put and the call. You really don't have to do both sides, but that's a whole
Right.
different discussion. Essentially, it's just it's a calendar or time trade, time
Yeah.
spread.
Okay.
Right.
Okay.
Yeah, and I think like Dave was mentioning too, you can be biased or you don't have to do both sides, and you could keep it on one side. I typically have just been testing both, so I've been looking at both, and you know, I don't disagree with you, and that's why I've been using the virtual portfolio and then tracking it in other ways, is because, you know, I'm, you know, for the lack of a better word, kind of nervous myself because I like to, you know, I want to be able to feel comfortable before I'm doing the trade. And like Joe mentioned, you know, when we do those iron butterflies, we know our risk going into the trade. Hey, this is the most I can lose, you know, perfect, you know, and you know it. Whereas the other one, I'm still just, I mean, I think the most you can lose is the debit, like Dave and Joe mentioned, but I'm still just kind of like, oh man, there's got to be something weird about them, you know. So, and your profit target is little less, little less defined, in my opinion, right? You can't really say, well, if the stock does this, then I should be able to get out for 25%. You might, you know, Dave might be able to do that, but I haven't learned that yet. But, you know, let me just show you too. This is the Microsoft here. I just wanted to show you guys because I did do the Microsoft in my account. But if we look at it, you know, the Microsoft was selling, you know, the 285 put for this week, selling the 285 call for this week. and then then buying the 285 call and buying the 285 put for next week's expiration. Total trade, when you look at them together, total trade was only, I'm saying only, but it was 180 bucks. So you're getting into the trade for $180 debit. So your risk is 180 bucks. And then if I looked at, then this morning when I got out of the trade, like Sudhir mentioned, Microsoft is fairly flat. For the most part, it had a little spike up, little spike down. But this trade together as a double calendar is trading at 262. So I got out earlier this morning for 255. So paid 180, or let's just say 180 for the trade, and out at 255. So almost 35% profit or so in a pretty short span. So that's just the best case scenario in my opinion, right? I'm showing you a good trade there. On the opposite side, we didn't have it in there, but Google was in there as one of those trades that was in that raw data. The Google trade was, the stock itself is up almost 4%. It was higher earlier. So the volatility crush trade was pretty flat when I look at it. But now the double calendar, I would have paid 15 bucks for it yesterday, 1,500 bucks, and it's worth roughly about, 10.50 right now. So that would be a decent loser. There's a good and the bad with those for sure.
Well, there is with all of them. Yeah.
That's right.
But so
that's right.
Dave, you're really doing these long call, long put or double calendars around earnings. Is that what you said?
Yeah, and I'm doing them the same time as the vol crush. So I did the vol crush or the non-mover as Microsoft, but I also did the double calendar as well to try to play it out. I've been following it for a bit, so I feel pretty confident in trading some of them, especially the ones like that 180 to 400 bucks or so. I'm fine putting those on and seeing what happens with the earnings, as long as they tested well for the non-mover or the vol crush. So I'm fine with that. But yeah, I'm putting them in there too to test them. So I just wanted to show you guys that.
Okay. All right. Thank you.
Yeah, cool, guys. Any questions or comments on that, guys? We have, we're coming up to 2:00, and I know a couple people have to jump off for other stuff. So just wanted to see if we had any questions or anything like that.
Well,
and feel free.
Yeah, go ahead. Closing comment on what how Joe commented to Gene there. And, the being confident or familiar, or you understand this, or that's part of where we're going here. So if there's something that's uncomfortable, Gene's uncomfortable at calendar trades, and I've talked to her a couple times on this. I trade those a lot, by the way. So if anybody wants to, watch, or I'll be happy to share several all the way through, and how they worked and why they worked. But the key is to get where Joe was talking, to get to understanding why these trades work the way they work, and when they don't work, why they don't work. So I think that's the key here.
Yeah, I understand. Yeah, it takes practice on all of these complicated strategies, if you ask me. But I guess, well, basically, I like to sell options. I'm not a buyer. I hardly ever buy anything. But that's just me.
I understand, Gene. I understand exactly where you're coming from, and that's okay too.
Yeah, I mean, it fits my personality, I guess.
Right.
Or risk.
No, and I totally agree with you too. Those are some of the vol crush and the non-movers are some of my favorite trades, and I like collecting that credit and kind of having that all laid out for me ahead of time. I mean, I just really enjoy them, and even some of the trades that don't come over as our plan, I still like to do some of those as well. Because they are consistent and they seem to work pretty well. So I excuse me, and I like selling it too, like you do, Gene, as well. So yeah, any of the trades on here, feel free to collaborate with each other, but also, feel free to contact me to kind of go over some of the stuff with you. Like I said, on these calls, I learn a lot from you guys, just as I hope you learn from me as well. So I feel that when we do talk one-on-one, if I'm not sure of something, talking it out and hearing it from you or talking it back and forth helps me learn. So feel free to set these things up so we can get together and, have more time. We have an hour or so on Wednesdays to speak, which isn't enough time to kind of go through some specific details in the trade. So, always feel free to to set some time up so we can get into the details, you know, a little more deeper. So.
Oh yeah, these conversations are always good, Shawn. I mean, we all,
No,
yeah, it's good to bounce all this stuff back and forth, you know?
yeah, and like I said, talking to you guys one-on-one, I feel like we can get a lot of information out of those as well. So it really helps. So, and these calls are a little one-sided. You know, Josh and I are talking a lot, but you know, like I said, when we find cool stuff, we want to show it. And then if you know you have comments or you know doubts about it, we want to hear that too. That's kind of what we're here for. So.
Okay, thank you.
So cool. Feel free, guys, to contact me with any questions, and you know, I appreciate you guys taking the time. But that's all I had, Josh. I appreciate it.
All right, thanks, Shawn, and thank you all. We'll hopefully have a Shook here next week. He said he'll be here, so hopefully that'll come through. So thank you all for attending.
Good meeting. Thank you.